Welcome, everybody. My name is Andrew Patricio, and for the last 20 or so years, I've been training business owners just like you, encouraging them, motivating them, educating them how to run a successful business. And it's amazing when you work with business owners on a regular basis, two things happen. One, you get really inspired and motivated by the ideas and the concepts they want to build. And the other thing is you learn so much from them. And I've learned a whole lot about cash flow over the years in my own businesses, but also in other people's businesses. And I've realized that cash flow is really something that we've got to understand, we've got to manage, and we've got to become really good at. The first thing is, and I want you to understand this, that the number one reason that small business owners fail is because they run out of money. That is the number one reason. So if that's the number one reason that small business owners fail, you and I need to be aware of this, and we need to manage our cash flow really, really well. So that's the first thing. The second thing is that you've got to understand that cash flow management is your responsibility. You know, there are different parts of our business that we can outsource or we can get somebody else to manage, but the cash flow is our responsibility. We got to make sure that there's enough cash flowing through the business to keep it up and running. How we get this cash is often through revenue, often through lending our business money or raising money through banks or other ways. But the key thing is you never, ever want to run out of money. I use a very simple example. Let's use an example. Let's say you're a youngster in your 20s and it's Friday night. You phone your friends and you say, I've got $500 to spend. Come over to my home and we'll go and spend it. A bunch of your friends will show up because it's something interesting. They'd like to help you spend your $500. Let's use the reverse situation. It's a Friday night, you phone all your friends and you say to them, listen, I've got no money. Why don't you guys come over to my house with your money so that I can enjoy my Friday night? The lesson I want you to get out of that is that as a business owner, when you've got money, you can build a successful business. When you don't have money, you're going to struggle. And people will run away from you when you don't have money. So just be aware of this, is that your rule must be very, very simple in business, is you never, ever want to run out of money. When I think of over the last 30 years of running my own business, this is my biggest nightmare. Actually, it's the thing that keeps me up at night. How do I ensure that I have enough money in my bank account to regularly pay my suppliers, to regularly pay my employees, to regularly pay my fixed expenses? How do I make sure that I have enough money to do that? Because I've realized as a business owner, when you run out of money, you lose all your suppliers, all your friends, everybody out there. So this is one of my key responsibilities, to monitor exactly how much is in the bank, when is money coming in, when's it going out, so that I have enough money in my bank. And I'm sure you've seen this before. There are certain businesses that are very, very profitable but have major cash flow problems because they're not managing the cash flow effectively. They're really not getting that money coming in and out of their business, and this is why they fail. Profitable businesses can fail without cash in it. So what causes our cash flow problems? I mean, what are the key? Because I think if you can identify the reasons you have a cash flow problem in your business, you can do something about it. And if you don't know what the problem is, well, you can't do anything about it. It's really that simple. So the first one and the most obvious is that you just don't generate enough revenue. If you're not generating enough revenue in your business, you cannot cover your cash outflows. So this has got to be one of your key focuses. How do we generate enough revenue to cover our outflows? And the key thing is you need to know what those outflows are if you want to cover them. So if I know that every month $10,000 is flowing out of my business, for my fixed expenses, I've got to at least cover that. So my sales is a key thing, because if I don't generate sales, I have a cash flow problem. So I need to make sure that my sales are sufficient to cover my cash flow needs. The second one, and one of the key things, and I think this is a big problem with small business, is you don't collect your money fast enough. And a lot of us struggle with this, especially if you sell to large companies. And if any of you online sell to large companies or even to the government, this is going to be a big challenge for you, because these large companies always take a long time to pay. It's part of their policy. And when they do pay you, they often will discount your invoices. So be aware of that could be one of your big issues. I often say to small business owners is that we need to become paranoid about collecting money. Actually, if you've ever sold something in the early stages of your business, the first year, 2 or 3 years, and not being paid for it, it's a very important lesson, because thereafter you focus on collecting your money. It's a key thing. We cannot trust people to pay us on time. We've got to make sure we put steps and processes in place to follow up if they don't pay us. So not collecting money fast enough is a big small business challenge, and something that you and I have to work on a daily basis. The third thing is undercharging, and I've seen this many times. You know, business owners will justify charging less, and they'll give reasons like, for example, if I don't charge less, I don't get any customers. You've got to understand the most successful businesses out there are the ones that are charging more. Think of any business that you deal with on a daily basis, with the exception of maybe Walmart, but any businesses that you are dealing with on a daily basis, they often charge more than their competitors. They justify it, but they charge more than their competitors. You can't be undercharging for your products or services and then still survive in business. You've got to charge a fair price for your products or services, and this is a key thing. Your expenses being too high. I'm paranoid about any expenses in my business. Doesn't matter how small or big they are. To me, I'm paranoid about it, because I've realized that to survive in a business when your expenses are very high is very, very difficult. So you got to make sure that you monitor your expenses in your business. Every single expense in your business, you need to be monitoring it. And the most successful businesses that I've worked with over the last 20 years are frugal business owners, people that watch every single dollar in their business. And I encourage you to be that type of person. You want to control your expenses. You do not want your expenses to get out of hand. You've got to make sure that you monitor them all the time. The other one that is a key issue, and something that often we'll neglect, or our employees will neglect, is your bad inventory management. For any of you that are in businesses where you need inventory, for me, this is a big nightmare. Whenever I walk into warehouses or storage areas where there's a lot of inventory, to me, that is money lying around that is not working for me. So you've got to make sure that you've got a really good inventory management system, a system where you don't keep too much inventory, your customers are happy, your suppliers are happy with the quantities you're ordering. Though that's what you want to do. You want to come up with this magical amount of inventory that everybody's happy, where it doesn't impact your cash flow, but ensures that your customers get their product on time. So you've got to make sure that you have a system, that you have a process, that you have a software and application to manage your inventory. And finally, the other key cause of cash flow problems is growing too fast. You've got to understand the impact that growing too quickly has on a business. Just think of it. If your business is growing fast, you're going to be employing people, you're going to be spending more money, your receivables are going to go up, your inventory is going to go up. All of those things have a direct impact. And really, you've got to understand this, and it's a key thing, that money is the oxygen of a business. If it doesn't have cash flow, it doesn't have oxygen, it will die. So you've got to make sure that the cash is flowing regularly through your business, that it's flowing and it keeps flowing, and that you don't run out of cash. The other thing I like teaching small business owners is that make sure that you apply for money long before you need it. And this is a key thing. You don't want to be looking for money when you need it, because this is how loan sharks survive in business. People are desperate. They go to the loan shark to borrow money, and they struggle. So as a business owner, you've got to understand the importance of looking for money long in advance before you need it. Never leave it for the last minute. So some of the things that you should be checking, let's say, for example, you're struggling a little bit with cash flow in your business and you've got a bit of a cash flow situation. And a lot of us do have these, and we go through them at different times in our business. And I really believe that it doesn't matter what stage your business is at, you could still have a cash flow problem. So some of the things you need to check, and it's a key thing, is are your clients paying on time? You'll learn a very important lesson in business, is that if you allow your customers to pay late, that's exactly what they will do on a regular basis. On a regular basis, they will pay you late. So you've got to become a little bit paranoid and make sure that your customers are paying you on time. So go and check. If you're giving your customers 30 days, your receivables should only be 30 days. So if you're doing a revenue of $100,000, your receivables maximum amount should be $100,000. As soon as it's more than that, you are extending terms to customers, or they're not paying you on time, and this is one of your nightmares. So just be very, very careful of that. Let's use a very simple example. Let's say my business is doing $100,000 of revenue a month. I'm open for 20 days a month. That's about $5,000 of revenue a day. So if customers are paying me 7 days late, that is $35,000 that I would need to come up with in the form of a line of credit to finance those late customers. So just be aware of that. Every single day your customers are late paying you costs you money, and it costs you cash flow that you could be using to grow your business. So check if your customers are paying on time. Another strategy is, if you're having a cash flow problem, is to maybe reduce your terms. And I don't know if you've ever seen companies doing this, but it's something that you may have to do. You know, instead of giving people 30 days or 60 days, you might have to say to them, you know what, we cannot give you 30 days, we've got to give you 14 days or 21 days or cash or whatever it is. But these are the key things you need to address, is that if you cannot afford it, you've got to reduce the terms. I had a very good example. One of the businesses that I ran years ago in about 1995 was a business that supplied restaurants with their dry grocery products and their cheese and things like that. And I remember when I started this business, I was speaking to this supplier, and he said to me, Andrew, this is how it works. The industry average is you give people 30 days to pay their invoice, and if you don't do that, you won't survive. And I said, I cannot afford to do that. And I said, if I give my customers 30 days, I will go out of business. So I knew this, that I couldn't afford to give people 30 days, so I didn't. I gave them 7 days. And was it difficult to survive supplying restaurants that were used to buying on 30 days, making them pay every 7 days? Yes, it was very, very difficult, but it was the best decision we ever made. Because if we had given our customers 30 days like the industry average was, we would have gone out of business. So you've got to understand that for some of you, you've got to negotiate with your customer up front and say, I cannot afford to give you terms, or I'm giving you terms and it's too long, we've got to reduce the amount of days it takes you to pay, and this is going to improve your cash flow instantly. So you reduce the number of days that people take to pay you, your cash flow situation improves immediately. The other thing you want to do is come up with a good inventory control system, as I mentioned earlier on. So you need to have a system, you need to have a process. And it doesn't have to be too fancy, but I mean, just having a piece of paper with every single product that you keep in your business, with inventory levels or stock levels that you need. For example, you might have, say, that we need to have 6 cans of tomatoes on our shelf on a regular basis, and if it goes down, we need to order up to 6. things like that work really well. But if you don't put controls in place, your employees are going to do what is easier for them. And if it's easier for me to order 10 cases of tomatoes at a time rather than 3 every week, that is exactly what I'm going to do, the thing that makes it easier for me to do. So you've got to make sure that you introduce a system, whether it's paper-based, whether it's spreadsheet-based, whether it's computer-based, the software written that controls your inventory. So when you're running out, it'll tell you, it'll say to you, listen, you're running out of this item, go and buy more. Or you're running out of that item, go and buy more. That's exactly what you want. That's the first thing. The next thing is you want to get your stock turns. And some of you maybe have heard of the term turnover. Turnover means turning your inventory over. And businesses that have big challenges with us are businesses, for example, that sell furniture, people that are in the fashion business where clothing is an issue because seasons change. You've got to make sure that you're getting your stock turns. And a good idea is to discuss this with your accountant. You know, what are the industry averages for your business? I know when I was in retailing years ago, 20 years ago, we used to always try and get 12 stock turns a year. So let's use an example. Let's say we do $100,000 of revenue a month. We want to have inventory of $100,000. That'll be our average on a monthly basis, so we get 12 stock turns a year. But if we could get the stock turns up to 13 or 14, that was even better. What that means is that we have less inventory in our store and we're generating the same amount of revenue, which is ultimately what you want to do. And the last thing is your product mix. You know, the different products that you have in your business, for those of you that have inventory, obviously if you don't have inventory, it's not a key thing, but you've got to make sure that you have products that are selling. And that is the key thing. I encourage business owners that have products that are not selling to maybe discontinue them, or, you know, just keep them, you know, order them on demand or whatever it is, because you do not want to have products that are not selling. And this is something that's very important, because if a product is not selling, it's sitting on my shelf. If it's sitting on my shelf, it's money I could use to grow my business that I don't have access to because it's on my shelf. So just be very, very careful of this. And I've seen some horrific examples over the years of people that don't manage their inventory properly and then have an absolute chaos in the business because they're not getting the stock turns. Their customers are complaining they don't have all the products that they need, and this is something that you've got to be monitoring. You know, I say to all my business owners is that in 2016, I don't believe you can build a successful business without understanding the numbers in your business. I really believe this 100%, is that a lot of business owners try and ignore the number side of the business, thinking they can hand it over to somebody else or they can get somebody else to do it, and really this is not a good decision. I believe that this has got to be our responsibility. It's our business. We've got to know exactly what monthly sales we need to cover our cash outflow. So on a monthly basis, what is the minimum amount of sales that I need to generate to cover the outflow of cash? So to cover my rent, my telephone, my marketing, my advertising, my salaries, my payroll, my taxes, whatever it is, what do I need to make every month? And I need to know that number because that's something that I need to achieve. You don't want to have your suppliers running after you to pay your invoices because you don't have enough cash. The second thing is make sure you know every single product or service that you are selling, that you know exactly what the profit is on these products, and identify the ones that you're not making a profit on and either discontinue them or increase their prices and increase your profit margins. It can be a really tough decision sometimes to increase our prices, but it's often the right decision because we're going to make more profitability, become more profitable, and we're going to build a successful business because ultimately, at the end of the day, a business is about making more money. We mustn't forget that. The third thing is your competitive price check. You know, And I encourage you, if you haven't done this recently, is get out there and do a competitive price check. See who are your top 5 competitors in the industry and how much are they charging for similar products and services that you are selling. So do your research, understand how much they're charging so that you don't underprice your products. And another thing you should do on a regular basis is check your profit margins. Get out there and do your research. Let me just tell you, most of you will probably know this, but this is how you calculate your profit margin on any product that you sell. Your selling price minus your cost price divided by your selling price. Okay, so that's how you calculate your profit margin on any product or service that you are. Service often don't have a profit margin because it's 100%, but this is how you calculate your profit margin, okay? And usually, I mean, you quote this as a percentage. So this is important that you do this as a business owner, that you know exactly what your profit margins on every single one of your products, and check it regularly. And the reason you need to check it regularly is that prices move up and down. So you need to be aware of what they are. So, and know this number for every single product that you sell in your business. It's key, and it's something you should be monitoring all the time. Now, the one thing that I've found about many business owners is that often we're not the most organized people in the world. So there are little things that we do wrong, little things that have a major impact on our cash flow. The first one is our invoicing policy. I want you to understand that you've got to make sure that you invoice promptly and regularly. You've got to make sure that you do that. As soon as you've supplied me with a product or service, you invoice me immediately. Either invoice me when you're supplying me, or as soon as you've done the job, or whatever it is, whatever way works. But make sure this is a discipline you have, because every now and then business owners will say things like this to me. I've been too busy to invoice you. I'm thinking, what do you mean you're too busy to invoice me? You're never too busy to invoice anybody. You've got no excuses nowadays. You can do it on your smartphone, you can do it on your computer, and it's really easy to invoice a client. So you want to invoice people quickly and promptly so that you can collect your money, okay? Regularly call to collect your money. So on a regular basis, on a weekly basis, I encourage you to go through all your receivables, go through all your outstanding invoices, people that owe you money, and give them a call. Phone them and say, listen, Sarah, I'm going to be in your area tomorrow. Can I come by and collect my check? Or can we have your credit card information so we can take payment? Or whatever it is, but regularly call to collect your money. And the best day to call for your money is today. That's the best day to do it. And make sure you do it on a regular basis. And if you're not the ideal person to call for money, and there could be a couple of reasons you don't want to call for money. Maybe you're not firm, or maybe you deal with the customers, you do the sales, so you find a little bit uncomfortable. In that case, you want to get a third party to do that. Maybe one of your employees, or maybe your bookkeeper or accountant. But you've got to make sure that when invoices are outstanding, you phone. You phone the day before it's due to say, listen, I'm going to be in your area tomorrow. Can I come and collect it? The other thing you can do is you can offer incentives for early or prepayments. I'm not overly excited about offering discounts for people to pay early, but sometimes that's the only thing you need to do. But make sure you work it into your costing, so it mustn't cost you money. When you quote this client, you assume they're going to ask for a 2% settlement or 3% settlement, whatever it is, so you're aware of that and you work it into the price. The fourth thing, and one of the key things, is I think that every one of us have certain clients that we do not like, and usually that means that they don't pay us on time, they're difficult to work with, and all those type of things, which causes delays in their payments and stuff like that. I encourage you to fire those customers. Really, Customers that aren't paying you, don't appreciate your work, those are the type of customers you do not want to be doing business with. And this happens often. You know, people be doing business with a customer, they buy the least amount, they pay late, but they complain the most. Those customers you do not want. Send them to your competitors. The other thing is just be very, very strict about your credit requirements. You know, just be very, very strict. You know, do credit checks, make it difficult for people to buy on account 30 days or whatever the terms are. So make it difficult for people to do that. Encourage people to pay with their credit cards. That is what you do. They need to borrow money from their banks to buy from you. That is what you want to encourage. Obviously, not always easy to do, but that's really what you want to encourage. So if you give people incentives to pay up front, that makes a lot of sense to me. Review every business expense, and I encourage you to do this. Now is maybe the perfect timing. It's coming towards the end of the year. You start analyzing your financials for the last 12 months, looking at every single expense. Which expenses are getting out of hand? And you'll be surprised at some of these simplest expenses that are costing you a lot of money that you didn't even realize. So be aware of this and manage this. Really be aware of this and manage these expenses. Review them, ask your suppliers to requote, look for more efficient suppliers. These are the type of things you need to do. Another word of advice, and for some of us, it's really the only thing for us to do, is increase your prices. You know, I've learned over the years that people that nickel and dime and try and get you discounts from you are often the most painful customers. When you increase your prices, this is exactly what's going to happen. You're going to lose some customers that are price sensitive. I had a very good example yesterday. I was having a discussion with a business owner that he does landscaping services and snow removal in the winter. And I remember last year or the year before having a discussion with him about snow removal, and he was saying, you know, he was going to get out of the business because it's not worth him doing and this and that. And then yesterday I spoke to him and I said to him, you know, so you out of the snow removal business? And he said, no, actually what we did is we increased our prices quite a lot to make it really worth our while. And I said, that made sense? He said, exactly. The problem was that before they were too competitive, when they increased their prices, they lost some clients, which they were okay to do, the cheap clients, but they kept all the good clients, the ones that bought from them because they're great service, not only their price. And so a lot of people think that when you increase your prices, you're going to reduce the amount of revenue you make. That's not always the case. And sometimes it justifies it. You increase the price, you lose some customers, but you make more profit, and that's the key thing. How do you improve your cash flow? Just become wiser. I mean, little things, and this is a very simple thing, but, you know, when you make a sale, just ask the customers to give you a deposit, you know, 50% or 30% or 25% or whatever it is. Just ask your customers to give you deposit payments. So my point here is to be aware of cash flow and think about it before you make the sale. Because some of us are so excited about making the sale, we forget to discuss the payment terms. So what I'm encouraging you to do is to be aware of this. When you're making the sale, you want to get cash flow. Do credit checks. You know, this might be one of your strategies. If you've regularly, I had a very good example last week. I was running a seminar, and this one guy said, you know, if a customer doesn't pay, what options do you have? And I said, it's really difficult because, I mean, if you don't collect the money yourself, you can hand it over to somebody to collect it. They're going to charge you a fortune to collect it. Or if you give it to a lawyer, it's going to cost you money. So all of these things are things that you need to try and avoid as a business owner. So you want to make sure that if you're selling to me, that I can afford to pay you, that I've got a good credit rating, I can afford to pay you. These are key things that you need to address up front, because you don't want to be selling to people that are either not going to pay you or they're going to struggle to pay you, because that is an absolute nightmare in your business. Go after more cash business. I mean, really nowadays you've got no excuse, you know, to set up a system to accept credit card payments. I mean, we Most of our clients pay us via direct transfer or checks, but we do accept credit cards, and the reason is that every now and then there'll be somebody that says to me, Andrew, do you accept Master and Visa card? And we've got it set up. So if customers want to pay us, I mean, it's going to cost us 2 or 3%, but I'd rather have the money up front than wait 30 days or 60 days, especially when I'm working with certain government departments. So go after that, ask people for their credit cards, accept credit cards, make it easy for people to pay with credit cards is what I recommend you do. The other thing you may do is if you want to liquidate some inventory is have a sale. If you've got too much inventory, just get that cash moving through your business. And that is the key thing. You want cash moving through your business. You want that cash flow going. And you can liquidate assets. These are all ways that you and I can use to improve our cash flow and get that cash flow going through our business. Obviously, you can always go and raise capital. You can go to the bank and raise money. But that is not my first choice as a business owner. My first choice is to get money from my actual customers. The other thing you can do is extend your payment terms. So negotiate with your suppliers so that you can pay 30 days instead of paying cash. And this gives you cash flow. And I've done this a bunch of times in my businesses over the years. When I didn't have money, go and speak to the suppliers, build up a relationship, and get 30 or 60 days to pay back inventory. And it worked brilliantly because that's really interest-free money that you're borrowing from your suppliers. Ask suppliers to requote. I mean, regularly do this. Say to your clients, my insurance is too high. I'd like to see what prices I can get. Can you get me more quotes? Seek out new suppliers on a regular basis. I would encourage you to do this. Again, make sure that you choose suppliers that give you value. It's not always about price. Be very, very careful. Obviously, price is an important thing that influences your decision, but it mustn't be the only thing. If somebody's charging you cheaper but giving you inferior products or services, why would you want to buy from them? Renegotiate your rent. If you're struggling to pay your rent every month, renegotiate with your landlord. Landlords would prefer you to stay. Well, I'm like that. I own a bunch of properties. I prefer my tenants to say to me, listen, Andrew, I can't afford to pay you $500. I can afford to pay you $400 because business is quiet if they are a reliable tenant. Again, you want to renegotiate if you have to, and examine every business expense. So these are things that you and I can do. We want to analyze. We want to look at our expenses. We want to see, is there an opportunity for us to get more value for money? And that is the key thing. You want to get value for money. You want to reduce those expenses that you can so that you can make more profit. When it comes to purchasing assets, this is something you've got to be aware of, is that this takes up your cash flow. If you're not borrowing money when you're purchasing an asset, it's taking up your cash flow. It's taking up money that you would run your business to buy fixed assets, which is a problem for me. So in some situations, not all situations, obviously if you've got the money, that's okay. But if you don't have the money, maybe renting or leasing assets makes a lot of sense because then it doesn't tie up your capital. Maybe buy used items. I mean, many of you have bought used equipment or used machinery or things like that over the years. And it makes absolute sense for certain industries where you go out there, instead of buying a brand new desk, you buy a recycled desk. Instead of buying brand new chairs, you buy recycled chairs. Whatever it is, these are some of the opportunities for you. Don't neglect buying secondhand. It may not work for everybody, but it could save you thousands of dollars. The other tip I always have for business owners is don't buy assets that don't increase your revenue, especially in the startup stage of a business. You do not want to buy assets that are not going to make you more money. If it's going to make you more money, then you can justify it. Otherwise, it could be a waste of money. And check your bank balance daily, which is an obvious thing, that every one of us should have our banking on our phones so that we can check on a daily basis what is our bank balance, what's gone through, what hasn't gone through, all those type of things. I, for example, create alerts on, maybe you can do this too, I'm not sure if your bank offers it, but I have alerts on my account. So every single time a check goes through my account, it sends me an alert. Every single time my credit cards are used, it sends me an alert. And the reason I have that is because then if somebody steals your credit card and uses it somewhere else, you at least have these alerts from your bank. You can contact your bank instantly, and they can stop any payments, which is exactly what happened to me a few months ago, maybe last year, where somebody bought something in the UK using my credit card, and obviously they'd stolen my credit card. This is probably one of the most important slides, and I'm going to show you how to do it today, is develop a cash flow forecast for your business. I work with a lot of young business owners, and I'm working on a couple of programs now. And for me, there are two key things, actually three key things. The one is that these small business owners price their products or services fairly. That's number one thing. The second one is that they know exactly what their break-even is, how much revenue they need to generate every month to survive in this business. And thirdly, that they know what cash is going to flow into their business and out of their business every single month. And the one thing I realize that business owners always get a little bit confused. There are two things. One is they don't put the timing of cash flows in correctly. So if I sell something this month and the cash comes in next month, well, that's when it goes in my cash flow. It goes in my cash flow when it flows into my business. That is the key thing. That's the one thing. And the second thing that they do wrong is they do not get their outflows right. They don't know exactly what their fixed expenses in their businesses are every month, which is a big sin because you need to know exactly what it is so that you can manage it and you can control it. So when you're doing a cash flow forecast, which I'm going to show you how to do now, the first thing is you need your sales forecast. So let's say, for example, I was doing a cash flow forecast for BizLaunch for 2017. So from the 1st of January of 2017 to the 31st of December 2017. The first thing I need to focus on is my sales. And when you do a sales forecast, make sure you're conservative and realistic. I find that often we are optimistic about our sales. I prefer to be conservative. One of the big advantages you have if you're an existing business is you have historical numbers. If you're a brand new business, you know what, it's difficult to calculate into your sales forecast, but that doesn't mean you mustn't do it. Based on the information you have, based on the interviews that you've had with certain business owners or competitors or people in a similar industry to you, you must know what your projected sales forecast is. That doesn't mean you're going to be 100% right or even 80% right, but it's going to help you to calculate the viability of your business idea and to see if you've got enough cash to keep this business up and running. So use previous year's numbers as a guide, which makes it easy for you to do, and always take seasonal fluctuations into consideration. And this is a key thing. You know, when you do a sales forecast, your sales should, in different times of the year, be up or down. I mean, if you've got a very seasonal business, for example, if you're in the ice cream business, it's going to have an impact on your revenue forecast every month. These are the type of things you need to work out. The second thing you want to know is your cost of sales. Obviously, if you're a service business, you don't have a cost of sales unless you have consultants and things that you outsource stuff to, but you won't have a cost of sales. These are the inputs. These are the ingredients. For example, if you're baking cakes, these are the ingredients that go into this cake. And for a business that sells products, this is a key outflow because when you buy inventory, that costs you a lot of money. It's money that's flowing out of your business that you don't have access to once you've paid for the inventory. So this is why you want to get inventory turns up really quickly so that you are managing your inventory well. Then you need to know your operating expenses, or if you want to call it your fixed expenses. Again, use the previous year's numbers as a guide. This is going to help you. Last year, this is how much I spent in stationery. This is how much I expect to spend this year. Again, with your expenses, I don't want you to be too conservative. With your sales, I want you to be conservative. With your expenses, I don't want you to be too conservative. And always add a contingency. You know, exaggerate your expenses a little bit is what I'm encouraging. And there's nothing wrong with having extra cash flow at the end of the year because you thought you were going to expend more and you didn't. So there's nothing wrong with that. The other way around could be a nightmare, where you underestimated your outflows and more money flowed out of your business than you expected. Then the other thing you need to know is what assets are you going to be purchasing for the business over the next 12 months that could have a direct impact on your cash flow forecast. So really, those are the things that you need to create a cash flow forecast. What I'm going to do now is I'm going to show you the template that I use to do my own cash flow forecast. And if any of you want, you can get this template and you can use exactly the same template as I'm using, okay? So yeah, this is just an Excel spreadsheet. I mean, I could have done it on Google Sheets or whatever it is. So let's use that example. Let's say I'm going to do a cash flow forecast for BizLaunch. So I have webinars, I have workshops, okay, so workshops, and I have conferences, let's say. Okay, I'm just going to put a couple of products in there. Okay, so I have conferences that I attend. So the first thing I'll do is, let's say I'm doing it for January. My basic charge for a webinar is about $2,500, depending on the client and the volumes they do. Actually, maybe let me reduce that. Let's say $2,000 on average that I charge for a webinar. Okay, that's for volumes. So let's say I've got a few volume customers. And in January, I expect to do 2 webinars. Okay, so that's what I expect to do. Let me just change that number. There you go. So 2 webinars giving me a revenue of B7 times B8. There you go. I'm just putting in formulas for those of you that, there you go. So that's my forecasted revenue for webinars in January. Let's say in February, I'm doing 3. Okay, let me just copy this number across here. Let's say I'm going to do it for the first quarter. So I think I'm going to do 3 in February, 4, sorry. So 3 in February and 4 in April and 4 in March, okay? So then I'll just do my calculations and there's my sales revenue from webinars. That's my forecast. Let's say I do workshops and let's say I charge, let's say $750 per workshop. And let's say I do 4 a month, okay? Let me just change that to a number. Okay, so let's say I do 4. February gets a little bit busier, 6, and then March busy, and 6. There you go. So there's my forecast for my workshops, okay? And let's say I go to conferences, and let's say I charge, it depends on the country I'm working in, but let's say $7,500 to attend, speak at a conference. And let's say I expect to do, let's say I expect to do none in January. Let's say I expect to do 1 in February, 1 in March, and let's say 2 in April. You go. So I would add up that. So remember, I'm doing a cash flow forecast for my business for next year. Okay. So let's just see my sales forecast. And again, you would do your own based on what you know about your business. So let's say my total sales, forecast, okay? So in January, I expect to do B9 plus B12, B9 plus B12 plus B15. Okay, there you go. So I expect to do $7,000. Geez, these figures are much too low, but that's all right. Let's just say I'm doing that. Okay, now I've got to work out how am I going to collect this cash. Let's say for webinars, they pay me 30 days. So we'll call that receivables. Okay, so we'll call that receivables, and they'll pay that in 30 days, say. Okay, and then let's say my workshops, they pay me in the same month that I do it, and that's cash payments. So I'd put that in, which is, in this case, $3,000. Okay, there you go. And then let's say, because let's say this is a brand new business, and it's not, but let's say it was, then I was doing the cash flow for that, and I gave the business a loan, owner's loan of, let's say, $25,000, okay? And then I got a bank loan to buy all my equipment, say, of $40,000, okay? Let's put that in. Then I've got cash outflow. In my case, will be my rent. Let's say it's $1,800 a month. Again, I'm just coming up with the random numbers here. So utilities, based on last year, my utility is going to be $200 a month, okay? Let's say my internet and telephone, my internet and phone, let's say that's $200 a month. Again, these numbers would be based on previous years. Let's say my website, let's say the web hosting costs me, I don't know, $50 to $60 a month. Okay, let's put that in. WebEx costs me about $400 a month, I think. Okay, so $400 a month, I'd put that in there. Let's say I was taking myself a salary of $3,000 a month. Okay, let's say I was doing that. Let's say I bought equipment for my business to get my business up and running, and let's say that cost me $65,000. Okay, there you go. So this shows the cash inflows and outflows for my business for the period of time. Okay, then I'd go to February, and let's say that $6,000 was my receivables. Let's say that $12,000 came in cash. Okay, in March, let's say my receivables was $8,000. $8,000. Let's say my cash sales were $13,500. There you go. And then in April, let's say my cash sales receivables were $8,000, so that's, let's say, $19,500 was cash sales. There you go. So that's my inflow. In January, I expected inflow of $68,000, getting an outflow of $70,000. I'm going to have a deficit in my bank account of minus $2,660. So I have a couple of options here as a business owner. Either I can go to the bank and get a line of credit, or I can lend the business more money. Let's say I'll give the business a loan, which it can pay me later on, okay? In February, my cash inflow is going to be $16,000, so things are looking up. My cash outflow is going to be $5,660. I'm going to have a positive cash flow of $10,340, giving me a closing bank balance. So this tells me at the end of each month how much cash I should have in my bank balance. So this is how I would go through this cash. Well, this is exactly, not this is how I would, this is exactly how I do my cash flow forecast. And then what I do at the end of January, I would go back in. So maybe make a copy of this cash flow forecast, say copy this cash flow forecast, and actually then at the end of the month put in the actuals. So instead of having the forecast here, and now I'm going to put in actuals. So I'd put in actuals into here, and this would make my cash flow forecast an accurate document. And this would make it really useful for me at the end of every month, because then I could make adjustments. So if I saw that actually things have gone much better than I expected, then I'd go to my cash flow and maybe up my revenue forecast, or reduce my revenue forecast. So that is exactly how I do a cash flow forecast. And it makes it very, very easy for me to manage the money in my business. Let's say, for example, if I see, let's say in May I get no revenue in, okay, but I've got a big cash outflow, for example, okay? So I've got a big cash outflow there, and let's say my bank account went to a minus. In this case, it's plus, but let's say it went to minus. So in January, I would see that in May, there's going to be a minus in my bank account. So I don't go and ask the bank for money in May. I ask the bank for the money now. I go to the bank and say, listen, business is going well, but in May, I think I'm going to have a deficit in my bank account. Can you please give me a line of credit? So that's what we do long in advance. And that is the key thing as a business owner. You want to do these things long in advance. You don't want to go to the bank when you're desperate. So I just want to show you, it's a little bit small, but I just want to show you what the full cash flow forecast would look like. Okay, so that's for the whole year. Let me just remove these little things here. That's for the whole year. That's my cash flow forecast, and I would fill it in for every month what my forecast is. My expenses are quite easy to do because I know what those are, and that's going to really help me manage my business. Before I have a cash flow problem, I will address it. So if you learn nothing else from me today, nothing else, is the importance of you managing your cash flow, making it your responsibility, and using the cash flow forecast to help you manage the money in the bank. So what I do in BizLaunch is the end of every month, I take my bank statement, enter these actual numbers into the same cash flow forecast, and that is exactly how I manage my cash flow, okay? Because then I can see, I reconcile my bank statement because I enter the information into my cash flow, then I can see if there's been any mistakes, if I've been overcharged, or whatever it is, credit card payments have gone through, all that information is available to me on one page, which is exactly what I want. So I encourage all of you to do exactly the same as I've just shown you. I want you to manage your cash flow because if you got money in a business, you can build a business. Money to a business is like oxygen. If it's got money, it can grow. Without money, it's very difficult for a business to grow because you can't buy more inventory, you can't go and get more customers, you can't get more employees, and it really stunts your growth. So use this information and build a very successful business. That is what I wish for every single one of you.